John in Mobile, you're on Winning at Life with Gregory Ricks. How can we help you, John?
Hey, how y'all doing? I was calling. I recently learned about universal life's been around a long time, but I've been asleep, I guess. Now they have an indexed universal life, which I'm sure most financial planners are using, and it looks like it's a very well designed program so that you can receive tax-free income.
Did you have a question about it? Because you described it
Yeah,
well.
is that one of the options that we use? Like when you take your IRA that you accumulated with an employer matched amount, and then you decide, well, here I am. And it's an analogy that a lot of people use is, do I want to pay tax on the seed or do I want to pay tax on the crop? Which you know what I'm talking about.
Yeah.
So it's like a Roth IRA. But this is protected as you don't have the downside.
Kinda. You're having to put in, once again, money going into life insurance is an after-tax premium that you're paying into it. And what you're speaking of, and let's talk about, typically there's 3 different types you see out there on universal/variable life. On a universal life, or sometimes they're going to be called flexible premium adjustable life. That's, I guess, the long technical name. So index.
That's the old one, though.
Well, no, they're all the same. It's just different vehicles. Index has been around for a long time. Variable's been around for a long time. I could give you year stamps, but they've been around for a long time. Traditional, for back in the day, the really around a long time is like your whole life insurance or term insurance, or that whole life could be defined as cash value life insurance. But typically on the no risk type of accounts of universal life, where you could have money growing in a universal life by interest credits or indexed credits. And index credits meaning upside of, say, the S&P 500 or the NASDAQ or the Dow as an example. Now, you're not getting the entire upside of that, but you're getting a portion of that, or you're getting all of it subject to a cap. And let's say it might have an 8% cap or a 10% cap. So you get all of the growth and it's credited to your account. Think of your account. Are you okay with me going forward on this, John? Good?
Oh, yeah, absolutely.
Okay, hang on.
They say that there's no downside because
there's downside.
Go negative.
Hold on. Let's hold on there.
Yes,
Think of your universal life insurance as a bucket. And you've got the premium going into that bucket. Then you've got those index credits that are growing, so the money's compounding in that way. But you do have some expenses coming out. There could be an annual contract fee or something. There can be, and there definitely is what's called mortality costs. And you have to think about the costs each year. That's the death cost, mortality costs. And those are 1-year mortality costs, and they increase each year. And of course, when you get much older, those are going to be higher, but you want to pump premium.
Just like term insurance.
Yeah, kind of like term insurance. So you want to pump premium in, get a good return, but like you said, it can't go against you. So if the market has one of those 30% plus drops like last March, your index account is not going to go negative for a 12-month period, depending on how the contract anniversary is. But you could lose those gains that you were accruing that year, but you can't go negative into last year's because those gains get reset and locked in each year. Now, there's a structuring of those that you're referring to, non-MEC policies, but that's where they can be designed to feed a lot of money in it, subject to IRS rules, to where, say, for example, and I've built some of these illustrations like this, I'll say, or proposals, like an example of somebody putting in $50,000 a year for 5 years, and meaning they've put in $250,000, and then say year 10 or 11 they start taking income, and just just call it, for simple math, call it okay, and they start taking out 20,000 a year. Once they've reached the 250 mark on the distributions, they've kind of pulled out what their cost basis is, the 250 in. But in 10 years, let's say they pull that out and they live for another 20 years. So they're pulling out another $500,000 above that cost basis. That's where the tax-free income comes from that, John. And the policy has to maintain in force, because what's washing that and making that a tax-free benefit and not biting your heirs in the rear on owing taxes is the life insurance washes that tax away, because life insurance is a tax-free death benefit. So that's kind of how that's structured there. So you've got universal life that you could build through interest credits. I am a fan of the index growth, where we get the upside
Absolutely.
and none of the downside. Variable, which is out there that I come across a lot, I would run the other direction from that, because those
Absolutely.
are
I'm talking
expensive
about index.
and you're carrying the risk. But I need to tell that for the listeners. You get that, but the listeners will see this variable and think we were talking about that. That means a variable is different from, say, the UL, where you get an interest or index. A variable is you get the upside of the market, you get all of it, and you get down. Typically, it's going to have more fees in it, but you're carrying the risk, and the risk could dry up that bucket of money and cause it to run out. I just don't like that scenario. You have any other questions, John?
I get it. Well, the thing, my thoughts on that were, they're saying that the money is distributed as a loan, so it's never taxed because it's a loan. And as long as you have, and your interest most likely is going to exceed the loan interest, because you can calculate it at 6.5 and the loan interest may be at 4 or 5 interest.
Yeah. Now here's a little warning on that. And that's structuring out there. But when that's built, and it's got to be built through the illustration, and you don't want it to violate the MEC rules, is how I'll simplify it here.
Part, yes.
And if you violate that, then you've changed the tax status of that, and they could be taxing you for those loan payments or distributions as you go. Whether they call it a loan or distribution, it's kind of the same thing. We're pulling money out.
If modified endowment.
And you just got to make sure that rule is not violated. And what we're talking about for the listeners is we're kind of treating it like an investment, but the IRS wants it also to act like a life insurance policy. And that's what makes it work for us, is we don't violate those rules that make it act like a life insurance policy, but we're really wanting that growth, and we're wanting that tax-free income down the road. That is a magical thing, and you don't have to put 50,000 a year in it. You know, was using that as an example to give you some simple math there.
Well, thank you. I appreciate that input.
Yeah, John, if you want to talk more about it, you can call my office, and as well as other listeners have questions about building something like that in your portfolio. And it's one way you can accelerate income, depending on how much capital you have to fund that. In some cases, John, people come to us and kind of like, max my 401k, I've maxed this, I've got this other one. What do I do with it? Well, here's an option for you that it isn't for everybody, but some people can fund that, and it's a pretty cool option to generate. Heck, you probably live in the 90 anyhow, so why not win? Beat Uncle Sam out of some money.
I appreciate this. Yeah, that's cool.
Thank you, John.
Well, thanks for your. Have a good one.
Okay. Yeah, great call.
Yeah.
Wow. I'm glad he brought that up, as a lot of calls do bring up topics that we just don't normally think about there. But we do set those up from time to time. It's situational, but it's a pretty cool deal. And if you want to find out more about that, call my office. Website's GregoryRicks.com. The office to start a conversation. You might just want to, hey, I want to talk about that tax-free life insurance benefit thing, or income from it, and just maybe set up a phone call with the office. Or if you want to come in, we have offices in Baton Rouge, Louisiana, Metairie, Louisiana, which is New Orleans area, Gulfport, Mississippi, and I forgot Mandeville, Louisiana. But we're a 15-minute phone call. If you're like John in Mobile and want to talk to us, yeah, just call the office, or we can do video meetings as well. That number is 504-832. This is the office number, not the show number. 504-832-9200. Love to hear from you.